Hi, and welcome to our presentation here at the Northwest Ag Show. I am Jake Carpenter, the Vice President of Investor Relations here at Equilus Capital Partners, and today we're going to present a little bit of information on strategies to preserve your financial legacy. And so I want to talk a little bit about how we're helping people in the Western United States and as well as Montana. And I want to talk a little bit about how some of these strategies that we're going to talk about today relate to them, and maybe they could also benefit you as well. So first thing I want to do is talk a little bit about our agenda today. I'm going to present a little bit of information about who I am and where I come from. We're going to talk about real estate investment trusts. We're going to talk about how to preserve wealth through capital gains tax deferral. And we're going to discover the power of something that's called a self-directed IRA. And then we're going to cover a little bit of information about our company and who we are and where we come from and why we're a little bit unique compared to maybe the other companies that might be out there for you. So let's get right into it today. Okay, my name again is Jake Carpenter. I am the Vice President of Investor Relations here. I have about 14 years of experience in the financial services arena. I cut my teeth in 2006 with life insurance and estate planning, business succession and wealth transfer. I earned a lot of industry accolades in the time that I've been in the industry. And I've spent a lot of time working very closely with clients, specifically business owners, farm owners, and real estate owners in a variety of different arenas to help them transition to the next phase of life, whatever that means to them. So our mission here at Equilus Capital Partners is to protect and grow investors' wealth through income-producing real estate opportunities here in the Northwest and in the Western United States. I do want to get into a little bit of a disclosure. Past performance doesn't necessarily guarantee future results. I am not a CPA or an attorney, so I'm not going to try to give any tax advice or legal advice. And so we do want you to consult your professionals, which could be your CPA, your attorney, your real estate professional, and other advisors before you make any decisions to make sure they're right for you. So first thing I want to talk about is something called real estate investment trusts. And so very simply, before I get into it, this is, if you've heard of a mutual fund, this is basically investing in real estate the way you might invest in a mutual fund. So a real estate investment trust was created by Congress in 1960 to give all Americans the opportunity to invest in income-producing real estate, whether it be commercial or residential. The most common types are an equity REIT, which is the acronym we use for Real Estate Investment Trust. They invest in and they own real estate, and the revenues are primarily from the leases on those real estate opportunities and projects themselves. Each investor, their name goes on title to the property, and the stockholders of a REIT earn a share of the profits from the income produced through the real estate investment. So it's in short, it's a way for you to get all the benefits of owning real estate without having to deal with the trash, the toilets, and the liability. So let's talk about some of the specific advantages in a real estate investment trust. They provide a liquid, non-capital intensive way to invest in real estate. Let's talk about that $4 million residential multifamily project that you just don't have enough money to write the check for. This gives you a way to participate in a $4 million project while investing a very small amount. Many have dividend yields in excess of 10%. A lot of the folks that we work with are in retirement, so it's very important to them that they be able to get steady, predictable income and a little bit growth on top of that. The great thing about real estate investment trusts is that the dividends are generally very generous, and they're very regular and come in very predictably over time. Dividend yields provide consistent income. This is really important to a lot of our clients. We are a very conservative company, and we generally work very well with folks that are more conservative in nature, and they're wanting to take less risk instead of more risk because they tend to be in their 60s, 70s, and 80s, and just kind of wanting to back away from the everyday management and the risk that comes with business ownership, or maybe being in high risk investments. REIT securities, or real estate investment trust securities, are a great tax management tool for the right circumstances. So for those of you that have owned real estate in the past, you probably understand the power of a depreciation schedule. And some of the REITs have a very advantageous depreciation schedule that comes with them. So if you've owned real estate in the past, you already know some of the tax advantages that come with that. REITs are largely uncorrelated with stocks, bonds, and mutual funds, which means they provide a great measure of diversification. So have you ever sat around thinking, I wonder what the stock market's going to do? I mean, especially right now, we're going into a new presidential situation for our country, and generally there could be a lot of market volatility, and you're just a little concerned about what's going to happen to the stock market. So this is a good way to diversify into income producing real estate in a passive way, where you're not actually having to manage the property yourself, while taking away some of the risk and moving some of that money out of a stock, bond, and mutual fund position into real estate. So before we move on to the next topic, I want to show a brief video that kind of goes over all the ins and the outs very briefly of how a real estate investment trust works.
REITs, or real estate investment trusts, were created by Congress in 1960 to give all Americans the opportunity to benefit from investing in income-producing real estate. REITs allow anyone to own or finance properties. In the same way shareholders benefit by owning stocks in other corporations, the stockholders of a REIT earn a share of the income produced through real estate investment without actually having to go out and buy or finance property. This video provides some insight into what REITs are and how they work. The REIT industry has a diverse profile which offers many benefits. REITs often are classified in one of two categories: equity REITs or mortgage REITs. Equity REITs own a wide range of property types, including offices, shopping centers, hotels, apartments, and much more. Equity REITs derive most of their revenue from rent on those properties. Mortgage REITs may finance both residential and commercial properties. Mortgage REITs get most of their revenue from interest earned on their investments in mortgages or mortgage-backed securities. In addition, REITs may be publicly registered with the SEC and have their shares listed and traded on major stock exchanges. Or they may be publicly registered with the SEC but not have their shares listed or traded on major stock exchanges. Or they may be private companies, not registered with the SEC and not listed or traded on a stock exchange. Regardless of the type, REITs operate under a specific set of rules established by Congress. A REIT is an entity that is modeled after mutual funds, is treated by the Internal Revenue Code as a corporation, must be widely held by shareholders, must primarily own or finance real estate, and must own its real estate with a long-term investment horizon. The IRS implements the REIT rules and oversees what qualifies as a REIT. The Internal Revenue Code requires a REIT to adhere to the following essential rules. At least 75% of the corporation's income must be earned from real estate as rent, real estate interest, or from the sales of real estate assets. At least 75% of the corporation's assets must be real estate assets. At least 95% of income must be passive. REITs are required to distribute at least 90% of taxable income annually to shareholders as taxable dividends. In other words, a REIT cannot retain its earnings. Like a mutual fund, a REIT receives a dividends paid deduction, so no tax is paid at the entity level if 100% of income is distributed. REIT shareholders pay taxes on dividends at ordinary rates versus the lower qualified rate. The top ordinary rate is now 39.6%. Over time, REITs and the rules and regulations that govern them have evolved to meet the changing needs of the real estate industry and the broader economy. But throughout that process, REITs have remained true to the mission laid out by Congress in 1960 to make the benefits of income-producing real estate accessible to anyone and everyone. And that's still how they work today.
So let's talk about our next topic, which is wealth preservation through capital gains tax deferral. And I'm pretty sure that most of you out there have heard of or have done something called a 1031 exchange. Now, a 1031 exchange has traditionally in the past and maybe in the present and future a great option for someone to defer capital gains tax on a piece of investment real estate or a piece of real estate. But the problem is a lot of you are business owners. So we run into a lot of situations where someone's selling a business and they're trying to defer capital gains tax. So let's get into this just a little bit. The first one I want to talk about is called a 721 exchange. And the 721 comes from the IRS code 721 exchange. You can also find this under something called an umbrella partnership real estate investment trust or an UPREIT. So 721 exchange allows for private shares to be traded for shares in an umbrella partnership real estate investment trust or an UPREIT. Shares are traded share value for share value. There's no capital gains tax in the trade because the value is embedded in the shares. So this is appropriate for somebody that's got a piece of investment real estate that the real estate investment trust would like to have in their portfolio. You have been looking for an opportunity to exit the management of that real estate, but you'd still like to have all the benefits of the real estate as well. So let me talk about the steps to execute a 721 exchange. The first thing is a value of the property has to be determined. So we do a certified appraisal generally to determine the value of the property that's going to go into the umbrella partnership. So now we form the partnership. Equilus Capital Partners being the real estate investment trust company. The partnership is formed with Equilus Capital Partners. Then Equilus Capital Partners becomes the managing member of that partnership. So step 3 is when Equilus Capital Partners moves the property into the umbrella partnership, and the property owner is assigned a share value equal to the appraised value on the property. Step 4 is where we begin participating in the benefits of all the different properties that are located in the umbrella partnership. Quarterly dividends, accelerated depreciation, capital appreciation, and you enjoy income from a passive position in the different projects that are located in the umbrella partnership. You have control of if and when you sell the shares and how many shares you sell. We recommend that your property remain in the UPREIT for at least 2 years. A lot of our investors tend to eventually sell portions of their umbrella partnership and end up in the real estate investment trust itself, but keep in mind that does create a taxable event for you. You can graduate your shares out of the UPREIT either slowly or you can find a buyer to buy the entire property, but it does create a taxable event. You can manage your tax liability instead of the IRS, and that's the benefit, is you have control over how much, if and when you sell that property. Your partnership in the capital, you participate in capital appreciation and capital depreciation inside the UPREIT. So now that I've said all that, let me tell you a quick illustration for a type of situation that would work really well under these circumstances utilizing a 721 exchange or umbrella partnership real estate investment trust. We have a gentleman that has a large multifamily real estate project that's for investment purposes, and he is enjoying somewhere around a 3% return on that investment. And so what he does is he comes to Equilus Capital Partners, enters into a partnership where Equilus Capital Partners is the managing member in that partnership. He contributes his property after we establish a valuation of it, and we are able to put him into a pool of other real estate projects that then allow him to enjoy a 6% dividend rate of return instead of a 3%. So this is something where he's able to relinquish the management of the property, he's able to increase his rate of return, and allow someone else to do the management and take a passive position in the real estate. Now, this property is held for a number of years inside the Real Estate Investment Trust partnership, and then can be graduated depending on how this gentleman would like to, if he wants to sell in small portions or sell it all at once, but it does create a taxable event at that time. But this gives a good illustration of the kind of situation that you may want to consider utilizing a 721 exchange or umbrella partnership real estate investment trust. The next topic I want to talk about is something called a deferred sales trust. So let me try to break this down for you in a nutshell. And in a minute, I'll illustrate how this works on the whiteboard. So first thing is you've got a property that you want to sell, and there's a lot of capital gains tax embedded in it. Now keep in mind, this is not, this can be more than investment real estate. This can be a farm, it can be a business. Remember, 1031 exchanges don't work with businesses. 1031 exchanges don't work with primary residences, but this can work in all of those situations. You have a highly appreciated asset. What we end up doing is it is a simultaneous sale to a trust that we create, and then the trust sells it to the buyer. And then the trust creates a buyer carryback note to the original seller. So this is a little bit confusing, but I will illustrate it on the whiteboard. In essence, when you sell to the trust and the trust turns around and sells to the buyer, there's no capital gains because you're selling at, let's say the property is worth $4 million, you're selling to the trust, and the trust is turning around and selling that property for $4 million to the buyer. Now there's a contract, a seller carryback contract. This is an installment sale note that's created between the trust and the original seller. Now, generally, most of our clients, they only want interest off that original principal. So as long as they're taking interest off that principal, they pay ordinary income tax, or they pay whatever kind of taxes is owed on that type of income produced, whether it be capital gains or income. Should the seller want to take part of the principal, let's say $100,000 a year, they can do that, but they will have to pay the capital gains tax on that original principal that was moved into the trust. So again, this can work with a business, it can work with rental properties, it can work with farms, it can work with pieces of land, and even primary residences. So I will illustrate this on the whiteboard so it makes a little bit more sense, so you're actually able to see as I walk through that concept how that works. So I want to go through a brief illustration with you to show you how the deferred sales trust works. A little illustration on the whiteboard. This is an oversimplification, but first of all, we're going to start with the formation of a trust, okay? We're going to form a trust, and we've got a highly appreciated asset. We're going to call this a farm, a business, or a piece of rental property, or a collection of rental property. Now, on a $10 million highly appreciated asset with close to zero basis, because they've been depreciating it out over the last 20, 30, 40 years, you've got roughly about $4 million of capital gains tax that's embedded in there. So what the seller is going to do is the seller is going to simultaneously sell this $10 million asset to the trust, while the trust then simultaneously sells to the buyer. So you've got a $10 million asset, the trust bought the asset for $10 million and sold it for $10 million, so there's zero gain to pay any capital gains tax on. So now the buyer, when the buyer buys this asset from the trust, there will be $10 million left in the trust, okay? So what happens here is the trust creates, in essence, an installment sale note or a carryback note to the seller, and they're going to pay 0 down payment, and they're going to, generally, this is structured to pay interest only. So it will pay a payment of interest. All right, so this is how it's nothing more than an installment sale with a 0 down payment and an interest only payment over, we structure this generally for 10 years. So this is the mechanics behind how the deferred sales trust works. There's a simultaneous sale to the trust of a highly appreciated asset. The trust simultaneously sells to the buyer. It's left with cash in the trust account. There is a note or an installment sale note that is created between the seller and the trust. It's a 0 down payment, generally interest only for 10 years. Now, inside of this trust, we create an investment portfolio that provides whatever kind of interest, income, or just payments that the seller wants. So we could pay out this trust completely over 5 years, 10 years. We could generate interest-only payments to the seller, but this is exactly how, in a simple, oversimplified way of illustrating it, how the deferred sales trust works. So I want to make sure I cover a really important opportunity for those of you that are concerned about succession planning and how to exit the farm, how to exit the real estate, get it in a position to pass on to the next generation, and how that can really work with your succession planning and your estate planning when it comes to utilizing the deferred sales trust. And the first opportunity is the fact that a lot of folks are trying to hang on until they die so that they can step up, they can get the step up in basis before it passes to their kids, so there's no taxable issues once it's passed to their children. And the interesting thing is this is a way for you to be able to sell to your kids, to sell to a buyer, and through the deferred sales trust, defer the taxes, which is really the issue that you're trying to avoid when you pass that asset after you die, and put your kids in a position to be able to take over that or to exit that farm and get it sold to a buyer where you can slow down and retire, you can create income. And the next greatest benefit of the assets inside the deferred sales trust is that those assets can be split up and left to beneficiaries equally or in whatever parts you want when the time comes and those assets need to be distributed. The great thing about the trust is you're able to do that by way of beneficiary designation instead of having to sell an asset and maybe not all of the beneficiaries want to sell it. Some of them want to keep it. So this is a really great opportunity for you to sell the asset, put it in a position where when you pass away, it can be passed on to beneficiaries of whatever amounts that you'd like to, and it's very friendly to pass on to the next generation, whether that be church, charity, or children. It's an easy way for you to pass it on when the time comes and maintain deferral while you're still alive. So let me just recap the advantages of a deferred sales trust. Tax deferral, number one. It is a great alternative to a 1031 exchange, and it tends to be much, much more flexible without the time constraints. There are a lot of estate tax benefits because depending on your situation, your trust can be designed to remove those assets that go into trust from your taxable estate. It maintains family wealth because instead of writing the check to the IRS for the capital gains tax bill, you're putting that back into your pocket to generate more income and growth that can be left to church, charity, family, and beneficiaries. It provides estate liquidity. So now you're taking a business, a piece of real estate, a piece of rental property or investment property, and you're able to convert it to cash and still maintain deferral. Whether you're in or out of real estate, you can still maintain deferral while having a liquid position. And it avoids probate. Trusts avoid probate and allows you to bypass probate, and provide proceeds to go to a named beneficiary according to the trust itself. So the last capital gains deferral strategy that I really want to highlight before we go into talking a little bit more about our company and who we are is called a self-directed IRA. Now, I'm going to tell you right now that this is probably one of the best kept secrets that you haven't heard about. Very few people have heard about it, and I'm not sure why, but we're going to get into it right now. So a self-directed IRA. Have you ever had a qualified retirement account, an IRA, a SEP or a simple, or an old 401k from a past employer, or maybe you currently have a 401k plan set up for the farm or the business, or the situation that you're in, and you just wish that you could take and invest some of that money and get it out of the stocks, bonds, and mutual funds and get it into some income producing real estate, or take a real estate position with some of it. I'm here to tell you that you can do that through a self-directed IRA. And the way it works is really simple. Well, it's nothing more than an IRA to IRA transfer, okay? And that is a non-taxable event. Once the money gets into the IRA, you let the self-directed IRA company know what asset, whether it be real estate, precious metals, or business interests, you want to invest in. Now, at Equilus Capital Partners, I do a lot of those transactions. So you really want to make sure, if you're utilizing a self-directed IRA, that you work with a professional to make sure the transfer is done in a way that won't trigger tax. And you've got to have a game plan for where those funds are going to be invested. A lot of people, where they go awry is they get the money over into the self-directed IRA and they're not sure what they want to invest in. So you want to make sure you work with someone to get a game plan to do that first. So let me just run through a couple of points that I want to cover to make sure that you understand all the benefits that come with a self-directed IRA. First of all, they reduce your exposure to overall market volatility. You get a chance to diversify out of stocks, bonds, and mutual funds and get into a real estate position. Maybe precious metals are your thing, business interests. You have a variety of other alternative assets that you can invest in through this. There's a potential to access more stable positions and assets, such as income producing real estate. Most of our clients they're already in real estate and they want to be more in income producing real estate and create diversity at the same time. And it allows you to build a better store of savings for your retirement and your later years. A lot of folks like to diversify into income producing real estate because of the attractive income that comes off of the real estate in a very stable, steady way to fund their retirement. Opportunities for tax deferral and tax-free return on alternative investments inside that self-directed IRA. So let's talk about that. If you own real estate inside of a self-directed IRA, and that real estate you've owned for 10 years, and then you sell it, if you're outside of a self-directed IRA, you're going to have a capital gains tax issue. But inside of a self-directed IRA, there's no taxable gain, there's no taxable liability until you pull anything out of the IRA. So this is a really good way to own and sell real estate and repurchase real estate without having to deal with a capital gains tax liability. Because as long as it stays in the self-directed IRA, it achieves tax deferral. So in closing, I just want to say we covered a lot of information, an enormous amount of information, and you're probably going to have a lot of questions. So please feel free to contact us. We'd be excited to answer your questions and help educate you on what your options are. So I want to thank you for your time in visiting with us and seeing our presentation today, and we look forward to visiting with you soon.